Well, markets are starting the week in the red as the geopolitical tensions ramp up with the latest escalation in the Middle East. The pickup in volatility has investors wondering what this means for long-term risk. All of this is putting even more attention on the Federal Reserve and the Bank of Canada as they weigh their next moves with rate cuts back on the table, but also maybe inflation a concern. For more on this, we're joined by David Rosenberg, President and Chief Economist and Strategist at Rosenberg Research and Associates. David, thanks very much for joining us.
Pleasure's mine.
You have to tread lightly at moments like this, don't you?
Well, I think that if you are a patient long-term investor, there's nothing that's happening here that should really alter your portfolios. I always say that it's a fool's errand to invest around geopolitics. You don't even have to go back and point to what happened in June of last year and that 2-week conflict with Iran, but just go back to 2022 when Putin invaded Ukraine, this is the way the markets operate. They get jumpy, they overreact, and you get this huge risk-off trade. Usually, at the onset of these geopolitical periods, the maximum move is usually at the very beginning. But nobody should be altering. I mean, if you want to trade around this, go right ahead. You want to turn bullish on the oil price because of all the concerns around the Strait of Hormuz and shutdowns of production facilities in the Gulf. To me, this is all going to be short-term in nature. If you want to define short-term as, say, the next 2 to 4 weeks. So I mean, personally, I'm not changing anything in my asset mix because of this.
And so you think this could be resolved within the next month? Or not, I guess maybe resolve might not be the word, but the fears will ease within the next month.
Well, look, there's always tail risk. You can't ignore that. But that would be my expectation. Because the one thing that we do know is that after being totally decimated last summer, and Iran doesn't even have any control over its airwaves, tells me that this should be over. I mean, I know you have people out there saying that we're in some sort of multi-month or multi-year quagmire. There's no doubt that Iran can do damage through its ballistic missiles, but at some point, its arsenal is going to wear out. The question is going to be, what's the resolve, not of the Israelis, what's the resolve of President Trump to see this through? So, could it be more than a month? Sure. The Ukraine war has now been several years. Everybody thought that Vladimir Putin was going to walk all over Ukraine. But even though that's been several years going on as far as Russia-Ukraine is concerned, the question you would have to ask yourself is, would you have just moved all into cash or all into energy in the winter of 2022 because of what happened with Russia-Ukraine? The answer is that if that's what you did, moved into cash and energy stocks, well, you would have missed out on a whole lot of other things going on. So it could last longer than that. But so long as you're confident is what the end game is going to be, and if the end game is going to be regime change in Iran, then all you can really think about the longer term, even if it's more than a month, is what that's going to look like from, I'd say, a general global stability standpoint. So I'm not generally known to be Pollyannish, but I'm putting my positive hat on this one.
And are you looking anywhere for any opportunities? I mean, we saw travel and airlines taking a hit today. Where are you dabbling at all?
No, I'm not dabbling because my nature, I'm not a day trader. And if you are a day trader, then yes, that's what you'd be doing. I think that coming out of this, the areas that get hit the hardest, as you said, airlines, travel, accommodation, they'll bounce back. And they could bounce back from a lower level, but those would be your greatest opportunities. And to be making, bullish assessments of what oil is going to be doing. Again, that's very short-term in nature, right? So many people were going bullish on energy in 2022, and it was a round trip in the oil price. You go back to the June of last year, the first day of that conflict between Israel and Iran, and of course the U.S. ultimately bombed Fordo. The oil price jumped 7% in like day one. So you got to separate what's transitory and what could be a tradable opportunity. But I would agree with I would agree with your premise that if you have liquidity on hand and you're looking at the stocks that are getting pummeled the most, those will be the ones that'll snap back the most. Once the clouds part.
And what does the Bank of Canada and the Fed do with this? I mean, if oil prices drag on, that could put inflationary pressures on. Where do you see all that unfolding?
Well, it cuts both ways. Energy gives you headline inflation, true, but it's also a serious depressant on real incomes, and then that affects domestic demand. And so one hand washes the other. As far as the Bank of Canada is concerned, I don't know how you look at those GDP numbers that came out late last week, and you look at the fact that the economy is basically at best flatlining. I mean, we're going to do well just to have 1% GDP growth in the first quarter. The Bank of Canada's last estimate was 1.8%, and the inflationary pressure in the economy is clearly subsiding. This energy impact aside, I think that the Bank of Canada, their next move is going to be to cut rates. I don't think they should be sitting on the sidelines, in my opinion, based on what's happening with the output gap in this country, the excess capacity in the economy, this inflationary momentum from the spread between aggregate demand and aggregate supply. I know I'm sounding like a economics professor here. I don't know why they're staying on the sidelines as long as they are.
Okay.
The Bank of Canada, to me, is an easier call, notwithstanding the fact that rates have come down a lot. People talk about, well, look where the policy rate is at 2.25%, but nobody borrows at the policy rate. The banks do in the interbank market. Nobody borrows at that rate. The average interest rate for the typical Canadian is closer to 5%. And people still talk about, well, look what the Bank of Canada's done. The Bank of Canada has just been pushing on a string because market interest rates, the interest rate that matters for most Canadians, haven't gone down nearly as much as what the Bank of Canada has done with the overnight rate.
Okay.
As far as the Fed's concerned, they've been talking hawkishly. They convinced the markets that the first rate cut in the U.S. is not coming until we're well into the second half of the year. And this is all happening before the events over the weekend. So the Fed is probably on hold. I think they'll be cutting rates too, but that's being pushed further out. The Bank of Canada, I think, is on thinner ice with its decision to stay on the sidelines indefinitely.
Okay. We've got to wrap it up there, David, but thank you as always for joining us.
All the best.
David Rosenberg is president and chief economist and strategist at Rosenberg Research and Associates.